Hello and welcome. You are watching Closing Trades here on ET Now. I'm Harsh Saita. Let's take stock of the index. Now, it's a fabulous move on the Nifty 50 as we speak. 0.5% higher, around 25,850 is where we're trading in at as of now. We're seeing 0.8% higher on the Nifty Bank. So that one is showing some bit of zing, and across the banking system, whether you call it large, mid or small, you're seeing very good traction among the banking names. And AU Bank is perked up 9.5% in particular. Federal Bank, again, out with numbers 7.5% higher. IDFC First Bank, and we had a conversation with Mr. Vaidyanathan. That one too is up 6.5%. PNB is up 4.6%. Bank of Baroda is up 3%. Can Bank is up another 3%. And Axis Bank up 2.5%. The only one possibly which has cooled off since the morning is a Kotak and an HDFC Bank. HDFC Bank down around 0.1%. Thereabouts, Kotak is absolutely flat. And from the top of the day, we've seen a bit of a cool off on that stock. Let's talk also a bit about ICICI Bank. Some amount of profit booking playing out there, 2.5% lower on an ICICI Bank. Now, that is with regard to, of course, the banks. Let's talk about the broader market names as well. The Nifty Auto, in fact, let's talk sectors first. The Nifty Auto absolutely flat. FMCG index up by just about 0.1% thereabouts. The Nifty IT is doing particularly well. So when you have that dual engine playing out, IT and banks, you'll likely see a positive outcome on the Nifty 50, and that's exactly how it is playing out. Let me zoom in on the Nifty IT. Talk about some names doing decently well, but it's the breadth and that strength which is leading the IT index higher. Again, Wipro is flat, but outside of that, Emphasis, it's TCS, Persistent, Infi, TechM, all of them doing 1% plus in trade. So fairly good day across the board where IT is concerned, and you're seeing good participation. Mid-cap IT and large-cap IT doing well on a day like this. Outside of that, metals absolutely flat. You're seeing a % move on the Nifty Pharma index as well. PSU banks, that's where a lot of the buzz also is. You're seeing 3.5% higher on the PSU banking index itself. Central Bank is up 6%. Bank of India, again, came out with numbers 5.5% higher. Punjab and Sindh, PNB, Bank of Maharashtra, all of these up 2.5+%. Again, some very, very good moves there. Nifty Realty is up around 1/3% thereabouts. Oil and gas is up 1.5%. So you're seeing a fairly decent breadth in terms of the sectors. But let's talk about the breadth on the Nifty. The Nifty mid-cap from those lows of the day has done fairly well for itself, is up nearly 1% in trade. Advanced decline also looks fairly decent and supportive of the kind of move we've seen on the Nifty mid-cap. The small cap, while up just about 0.4%, you're seeing a decent move again from the lows of the day. It's gaining decent traction. So you want to keep your eye out on broader markets as well, because that's where some bit of the recovery seems to be playing out, both on the Nifty mid-cap and the small cap index. Kunal, what are you spotting last hour and a half of trade?
No, this is a phenomenal market, Harsh. So I think on one hand, yes, it's more large cap names which are doing very well. Mid caps and the small caps, they're looking a little bit more tired, but then I think that's how the market texture has been, for the entire October series so far. And we've seen right from the start of October that you've seen few of the select larger cap stocks have been participating more like in a shuffling manner, where you see, for example, the first leg, you saw the PSU banking names doing well. Then FMCG stocks had their part to play. Last week, I think for second half, you had the real estate stocks, which looked quite strong. And now you have Reliance Industries, you can't miss out, on the index coming closer to the life highs, and Reliance Industries trading 10-15% lower from its lifetime high levels. So it's trying to play a catch up for itself. I think that's how the market texture could remain for the next couple of days. Trading could be a little bit more difficult if you're concentrated more on mid caps and small caps. But then, hey, if you have large cap names, I think nothing to complain.
Yeah, what about Reliance now? 3% up. Now what? What next?
So this is a very strong catch-up move. We were discussing this last week that the stock has to do something to try and cover up this 15% underperformance from the lifetime high levels. So I think it's trying to play that catch-up. This, I think, should be a breakout move for Reliance Industries. I would expect that the stock should see a follow-through up move, if not tomorrow or over the next couple of days, at least over the next 1 or 2 weeks. And this jump of around 60-70 points, what you've seen for Reliance Industries from Friday's closing, I think we could be looking at 1500 to 1520 as now the next target for the stock.
1500, 1520 as the next target. What do you make of the move on some of the NBFC names, Kunal? I didn't discuss that, but you look at a Shriram Finance, a Bajaj Finserv, both of those doing 3% plus in trade. Not often that you see some of these stocks move 3% in a single day. What's the take on those?
Yeah, and to compare it with this manner, that L&T Finance, which is one of the stronger names, that stock is underperforming. Bajaj Finance is flat. So I think in that sense, it's that's why I said that making money in terms of individual stocks in trading is going to be a little bit more difficult unless you are selective about the kind of stocks which you're picking for that particular trading session. But I think this is a very strong move for Shriram Finance particularly. I'd recommend this last week also, because my expectation was that the stock was forming a bullish flag formation on the charts on the daily time frame. The stock was due for a breakout. That breakout has finally happened today for Shriram Finance, and I think this should augur very well for the stock in the near term. Now, actually, what's the best part about this, Harsh, is that Shriram Finance, now after completing a daily pattern, is now on the verge of completing a monthly pattern on the bullish side. So, which means that this is not the final leg of the rally. This could be a start, which could be potentially a multi-week or multi-month rally further for the stock.
So, Shriram Finance definitely on the radar, Kunal. What about an ICICI Bank? 2.5% lower. And I'm sticking with the larger names because you have strong views on that. And ICICI Bank down 2.5%, buy on dips. Is that something that you would implement as a strategy on this one?
I was actually surprised when I looked at the data, after I saw ICICI Bank opening, I think down 0.5% or 1% down, in the market open. The last, I think, 7 or 8 trading sessions, there was a 15% withdrawal of open interest. So the open interest had gradually reduced for ICICI Bank, which means the expectation was that maybe the stock would come out with a result which could be a little bit more surprising. And the market participants just wanted to take out their positions and just wait out for the results. I think today we'll need to see the open interest built up yet again. So if we see a rise again from the open interest side, which means that there is a further opening of short positions on ICICI Bank. But if it is not, and if there is a further unwinding, which means you are looking at the stock going to a drag for another 2 to 3 weeks. So I think today's price action is one part, but the trend in terms of the open interest, I think that's the one which is going to dominate the stock price trend.
And we'll talk about that tomorrow before open. So viewers can get a sense on what to do and how one should position themselves for an ICICI. Wait and watch is how I would assess that. But what we'll do, viewers, is slip into a very short break. On the other side, I'm curious to know Kunal's views with regard to the PSU banking pack, because that one is completely on a different planet. 3% higher. We'll talk about that. So staying with us here on ET Now and wishing you and yours a very happy Diwali if we haven't already had the chance to wish you so. Though, Kunal with us in conversation. Kunal, your picks for this afternoon.
So 2 buy calls, and Hindustan Petroleum is the first stock which I would suggest as a buy. I think it's a fantastic chart on the short term as well as on the medium term basis. So would look out for targets in the range of at least 470 for HPCL, and stop loss could be kept at 445. And Hindalco is the other stock which also looks extremely attractive. I sense a metal stock going into a major rally. So would look out for 810 as a target for Hindalco, stop loss at 770.
Okay, and we did promise viewers a view with regard to PSU banks. Any names in mind, and what do you make of the move today? Phenomenal move.
Yeah, it's an exceptional move. It's more like a carry forward move. What started off with SBI breaking that 820 mark, I think almost 2 or 3 weeks back, that has led in confidence to the entire PSU banking lot. And now you're looking at fresh names heading towards breakout. I think from current levels, if I have to take a fresh bet, I would look out for Bank of Baroda, PNB, Canara Bank, as well as Bank of Maharashtra. I think these could be the top picks which traders could look at a buy.
Well. Slew of names in Kunal's armor to talk about with regard to where PSU Banks is concerned. But let's bring on board Shibani Sirkar Kurian, who's Senior Executive Vice President, Fund Manager and Head of Equity Research at Kotak Mahindra Asset Management. Great having you, Shibani. Good afternoon. Let me start off and take a cue from what we were just discussing with regard to PSU Banks. That move today, yes, but let's think about this maybe from a 2-year perspective. A lot will need to be done if the kind of returns that we've received can be replicated, especially within that PSU banking pack. What's your sense? The ROA re-rating, ROA drivers, are there enough? Is there enough steam in the ROA to sustain the kind of move we've seen already on the PSU banking names?
Hi and good afternoon, and a
Hi.
very happy Diwali to you and to all your viewers.
Wishing you the same, ma'am.
Thank you. So, when you talked about PSU banks, let me just take a step back and maybe discuss what's happening in the overall banking sector and then come to the PSU banking pack. So, our view on banks has been that this is a sector where there has been significant number of headwinds, lower credit growth, margin pressure. But we are possibly coming to the end as far as both credit is concerned, and therefore we start seeing some uptick as far as credit growth goes. And the recent management commentary seems to suggest that, especially where retail is concerned. And the second is the kind of margin pressures the bank was seeing that should start to abate. Of course, given the fact that there are no rate cuts at this point in time. So, therefore, you have a sector where incrementally from here on, earnings growth should start to pick up, led by core earnings, and valuations are clearly in your favor. Now, in this context, our preference has been for the private banks. However, within the PSU banks, there are specific picks where some of the larger PSU banks are better placed to benefit both from credit growth picking up, especially on the retail front, as well as margins bottoming out because your cost of deposits start to play out in terms of lower cost of funds. And these banks, which have a better retail liability franchise, are well placed. The sector, in terms of valuations, is attractive, especially with relative to history, notwithstanding the near term move. So, overall, our view on banks is positive, slight preference for privates, but within the PSU bank, our preference remains for the larger names where you still see possibility of return ratio improving and valuations are in your favor.
Shivani, hi, good afternoon. This is Nehi also joining in, and once again wishing you and your team a very happy Diwali. Shivani, you've spoken to us about PSUs and private banks, but what about the third pocket in the financials basket, the entire NBFC group of stocks? Where do you think this segment could be headed going ahead? What about asset quality, disbursements, or overall your sense on this entire segment?
So, our preference within the overall banking space or overall financial services space is slightly tilted towards banks. Within NBFCs, we have been fairly stock specific, looking at NBFCs where growth has been strong. And as you mentioned, asset quality is a clear differentiator. Within the overall pack, if you look at two segments, or rather three segments, which had seen some stress, one was the unsecured piece, which is typically your personal loan, credit cards, etc. The second part, where there was some increase in delinquencies, was the SME segment. And the third was the microfinance. Of this, the unsecured piece and microfinance stress seems to be bottoming out. On the SME or the small business loan segment, we will need to watch out for incremental stress. So at this point in time, it does not seem to be a major systemic issue. Now, within the NBFC pack, of course, valuations are not as attractive as it is in the case of banks. Therefore, sorry, excuse me, and therefore we have been selective as far as NBFCs go.
Minutes to catch your breath, Shibani. Please do that. You've got a host of sectors actually which have outperformed the market, right? One is PSU banks, another one is auto. Give us a sense on how you're playing consumption, Shibani. Is there a way in which, is there a particular theme you're riding on where consumption is concerned?
Yeah, absolutely. So consumption has been the other pack apart from banking where our view has been positive. There have been a slew of policy measures, both from the fiscal side, starting with the tax cuts that happened during budget, followed by the GST rationalization, as well as monetary push because of the 100 basis points of rate cuts that we've seen, which have translated into lower lending rates as well. So overall, our view on consumption has been positive, but within consumption, our bent has been towards the discretionary pack, where we believe that because of the policy measures, discretionary consumption should get back on track. And if you look at the data that is flowing through, especially during the festive season, that data seems to corroborate that there is indeed some pickup in demand that we have seen across the board. And within that, the biggest beneficiary in our view is the auto pack, especially the two-wheelers, as well as some amount of the entry-level four-wheeler segments, which had been languishing for quite a while. So therefore, in the entire discretionary space, one of our preferred picks has been the auto space, specifically the entry level four-wheelers as well as the two-wheelers, which we believe will benefit significantly given the kind of policy stimulus that we have seen. The data, as far as what we have seen, initial signs during the festive season seem to corroborate that. Of course, post this, we'll have to see whether the demand trend continues or not, but clearly it seems to be moving in the right direction.
So, auto is a pocket that you're liking from the entire consumption theme, Shibani. But what about consumer durables from that pack? We've seen the GST relief come through. They have been passed on. Of course, we'll see a staggered effect of that as well. But by when do you think we could see a revival in this entire segment of consumer durables? And where do you think that segment is headed is headed ahead? Because now that summer and monsoon pressure is also largely behind us.
So some parts of the consumer durable segment clearly got impacted because of the weather patterns. Some amount of that demand should start to come back. And of course, the weather related disruption as far as demand goes is possibly behind us. So this is also a segment that does benefit because of the changes that you have seen from a policy perspective. We do expect to see going forward some amount of that numbers coming through. Within the consumer durable pack, if you look at the data that is coming through, the smaller ticket consumer durable segment seems to have received a benefit or a push faster. So maybe we will see that picking up. Overall, if you look at the entire discretionary basket, while we spoke about autos as a pack, but we also believe that consumer durables, retail, quick commerce, all of that falls into the same basket. And hence, the entire play on the consumer discretionary side spans across all these sectors that we have been discussing.
Shivani, which will stand out for you over the next 12 months, turnaround-wise and valuation-wise? Of course, there's plenty with regard to earnings that is anticipated maybe over the next quarter or two. But give us a sense on that one sector that you're super bullish on over the next 12 to 24 months.
So one is from an earnings perspective, we do believe that while the current quarter earnings estimates are muted, and if you look at consensus, we are looking at a single digit kind of an earnings growth for Nifty. H2 should pan out to be better in terms of earnings. And then going into FY27, it is likely that Nifty earnings picks up and we see mid-teens kind of an earnings trajectory. From an earnings perspective, one large sector that stands out going into FY27 is a sector that we've already discussed, which is banks. Banking sector earnings for 26 is likely to be muted because of the various factors that we were discussing. But from here on, going into 27, this should be one large sector that contributes to the overall earnings for Nifty as a whole. Apart from banks and consumption, which are our top two sectors to look at, the other segment that we have been positive on is healthcare as a space, specifically hospitals. Here we believe that penetration levels continue to be low. There are bed capacities that are being added. However, we believe that occupancies will catch up. And more importantly, we believe that return ratio profile of the sector remains strong and healthy. And valuations, while there has been an uptick, given the growth expectation, valuations still are reasonable and there are pockets of opportunity. So net for us, three large sectors: discretionary consumption, banking, and healthcare. These are the three segments that we are positive on.
And Shivani, what about IT? If I could get your view over there, given the kind of underperformance we've seen and the numbers so far, they've not been all that bad. In fact, they've been quite decent. Your outlook on IT, and do you believe it could be a turnaround sector or would it be a contra call for now?
So IT is somewhat of a contra call for now. The way to look at it is, of course, so far the results have been in line with expectations or slightly better than expectations. However, there is still some degree of uncertainty as to how demand starts to improve in the near term. Remember, we go into the second half of the year for IT, which is seasonally a weaker quarter because of lesser number of business days, furloughs, etc. So therefore, near term, it is likely that the sector does see muted trends as far as top line growth is concerned, which is the primary driver for the sector. However, there is also a lot of debate that's going on as to whether AI will take away growth from the IT services pack. Here, our view is that as enterprises adopt AI more and more, there is a lot of work that is there for the Indian IT services segment to benefit from. And therefore, while near-term trends would likely be challenging for the sector, but one, as we see macro stability come through with rate cuts in the US, that would be one key factor to watch out for. And second is, as enterprises adopt more and more AI in their overall workflow, IT sector should start to benefit and start seeing improvement. Remember, deal wins have been strong. So if you look at the data from the second quarter as well, deal wins continue to remain fairly healthy. It is about translation of deal to revenue, which is awaited. So this is a sector which we are on a wait and watch mode.
Okay, on IT, a wait and watch. Pharma, Shibani, it's something which has done reasonably okay. Scope for upside from here, just trying to get a sense.
So pharma is a large sector, and there are different packs or different parts of the sector that we need to evaluate. One we already discussed, which was the healthcare pack and the hospitals. So that's one segment of the pharma space where we remain fairly positive. The domestic pharma piece, which is the domestic formulations business, continues to show steady growth. And here we believe that growth trajectory should continue and margins hold up fairly well. And therefore, within the pharma pack, our bent has been towards the domestic pharma piece. Some opportunities also coming through in the CDMO segment, given what's happening globally, where large innovators want to diversify their supply chain and will possibly look at opportunities in India, as well as the healthcare piece. The US generics market is somewhere, while pricing pressures have abated and have stabilized, but clearly growth is something that we will have to wait and watch out for. And of course, the uncertainty relating to tariffs still remains, though the chances have possibly reduced. So if you look at the pharma pack, the three key segments where we are positive: one, the healthcare piece, which is hospitals; second, domestic pharma; and also specific names within the CDMO pack.
All right. Thank you, Shibani, for that. It's been an engaging conversation. You know, we've covered wide range of sectors and we've spoken about things that you like. Thanks so much for coming in, sharing with us and our viewers all of your views. Thanks for coming in. Okay, what we'll do, viewers, also is slip into a very short break. On the other side, we'll continue to talk stocks. We'll get a sense on what's driving that 3% move on a Reliance. Stay with us. Really, the premier headline today is with regard to Reliance Industries. It's a very strong set of numbers with regard to what Reliance has reported versus estimates. Ashish Shah is here with a detailed deep dive on those numbers and the stock, which has moved 3%. Just trying to understand whether it warrants this kind of a move, Ashish Shah. Give us a sense.
Well, yes, the stock is up 3.5% and also the biggest gainer on the Nifty 50 index after it reported very strong set of numbers for the second quarter on Friday. Brokerage houses, though, continue to believe that earnings momentum and earnings trajectory is likely to continue going forward as well. Remember, retail segment reported very strong set of numbers for the quarter gone by. We were working with an estimate of about 3 to 4% revenue and EBITDA growth, but this came in at a solid 7 to 8% on a sequential basis. So retail segment performed very well in the quarter gone by. O2C segment, telecom segment, which reported ARPUs at 211.4 rupees versus 208.8 that the company had reported in the previous quarter. Across the board, it was a good performance. All segments were firing across all cylinders, and this is exactly the reason the stock is up 3.5% today. Remember, brokerage houses, as I mentioned, continue to remain positive. Most of them have not changed the target price, but they believe that new drivers of growth, mainly the telecom business, where pricing action is likely to aid earnings growth for the company going forward. Retail segment outlook continues to remain very positive on account of consumption boost and rising footfalls at most of their stores. So across the board, very good performance, and hence the stock is up 3.5%, the biggest gainer on the Nifty 50 index.
I know that I'm putting this bolt out of the blue, but give us also a sense on what brokerages are making of the result. Are there any target price hikes, any material ones that you saw?
Well, yes, no, there are no major target price increases, but sure, I'll take you through two brokerage reports. One is Macquarie. They've maintained their outperform stance on the stock with a target price of 1650. They say that it was a broad-based recovery that we saw, especially especially in the retail segment. As I just mentioned, Jio was steady. Oil to chemical segment is showing improvement on a sequential basis. Retail growth was driven by robust traction across verticals, and the ARPU growth was also very solid. So Macquarie, they've maintained their outperform stance. 1650 is the target price for Reliance Industries. They say earnings momentum is returning, and they are projecting FY25 to 28 EPS CAGR of a solid 15%. We also have Morgan Stanley maintaining overweight stance. 1701 is the target price. They say retail segment is driven by strong recovery in grocery business and fashion business. Telecom and Geo segment was in line. New energy initiatives continue to remain on track after the solid 75,000 crore investment that they had announced in green energy. Of course, the street awaits more clarity on how that will be spent. But for now, brokerage houses haven't changed their target price. But yes, they continue to maintain and believe that earnings trajectory is likely to continue going forward, especially for the retail and the telecom business.
That Ashesha, we'll let you go. Near 20% upside if we look at Reliance's stock price at the start of today from the current, or rather the stock price at close on Friday, the kind of target prices that we're seeing, near 20% upside. So, and that is by Macquarie, Morgan Stanley and the like. So limiting ourselves to that. But talk to us about charts. You said you're bullish with regard to Reliance, Kunal. Talk to us about what the levels are, at least in the short term, that one should look for when you're trading a Reliance.
So let's look at it this way. That the stock opens with a, this week with a gap up note.
Sure.
And when was the last time the stock had shown such a kind of a similar weekly gap up? I think that was in March, April 2025. That was the point when Reliance Industries was almost at 1400 levels thereabouts. And in the next 8 to 10 weeks, the stock jumped up towards 1550 mark. So which means potentially another 100 points. After that, strong up move for Reliance Industries. Now, even if you do a like-to-like comparison over the year for Reliance Industries, at current levels of 1460 thereabouts, we could be looking at least another 80 to 90 points jump after the 60-point up move, which means closer to 1520 is where I would expect the stock to head towards. It may not happen immediately, Harsh, but I think that process will take maybe another 4 to 5 weeks for the stock price to keep on moving up higher. But even that happens, it plays a very direct advantage to the benchmark indices because of its high weightage on the Nifty.
Correct. And Reliance isn't the only one that's moving. There's another one which has made a stupendous move today. After posting a good Q2, CEAT is now looking at a double-digit growth for the full year FY26. We caught up with the Managing Director and CEO, Arnab Banerjee, to understand the business, the guidance, and what we can expect over the next few quarters to unravel. First, listen into that piece before we take a view.
It's a very good move, a very positive move, which will stoke demand for tires, especially in the smaller towns and in the rural markets. We see an uptick in demand for all category of tires, starting from truck tires, where the benefit that we have passed on the entire benefit would be about 1500 to 1700 rupees per tire, which is significant. Two-wheeler tires, which are very strong in the small and rural markets. So we think this is a positive move for demand creation for the entire industry. And we would like to ride this demand and deliver a double-digit growth for the full year. There will be an uptick in demand, but it will pan out over a longer period of time. So we'll have to wait and see. On the international front, we expect the tariff situation to stabilize somewhere in the second half, if not in Q3 by Q4. So that will give us some visibility to our growth. We have diversified our international business to some extent. And today it doesn't matter to us because our exposure to US is very low, but we expect positivity from the international sector as well.
Okay, solid set of numbers from CEAT, and that is reflecting in the stock price also about 13% higher, as is the case with JK Tires. In fact, all the other tire companies are also doing well. So this positive earnings from CEAT is rubbing off on something like an Apollo as well. Kunal, your view on some of these tire companies, CEAT, JK, which one are you liking at the moment?
So JK Tire is something which I've been bullish on, and I think that's a stock which looks attractive. So again, what's been happening is that, this auto ang space tire stocks, they were waiting for some sort of a trigger in terms of a breakout because these stocks were going through almost 4-5 months of a massive consolidation. Now, JK Tire made a high which was around the 385 to 400 mark in the month of March, April 2025. And post that, these stocks had gone through a massive grind or a ranged kind of a price action. After today's up move, we are looking at a breakout of sorts for the stock price. Now, again, a very similar kind of a indication what I was discussing for Reliance Industries, that after such kind of a strong weekly up move, the question is that whether these stocks have a strong follow through. Now, we are looking at a weekly breakout for stock prices, and especially at a point where these stocks have been underperforming over the last many years. 2023-24 high for JK Tyre was approximately around 550 mark. So I think even if we compare from that 550 levels, the stock is still down 25-28% from that kind of a high. So I think at current levels, we should be looking at the stock going to a mean reversion or covering up this massive underperformance from 2024 highs. I would look at say 460 to 480 as a positional target for JK Tyres, and maybe a similar 5 to 10 upside for names like Seat, etc.
Wow, another 5 to 10% from here, and in fact on a JK, nearly 15% from here in terms of returns that Kunal seems to be pricing in. Some of the other names that are also buzzing in trade are some of the smaller banks, and IDFC First is one of them. Let's talk about this one first off to start with. Let's go across, let's listen into what the management had to say, especially with regard to asset quality. Let's pull that piece up. We spoke with V. Vaidyanathan, Managing Director and CEO of IDFC First Bank, where he's highlighted the bank's quarterly performance, and he talks about how he sees the performance. Listen in.
The NPA formation for the bank, YOY has come down, quarter on quarter has also come down. You can see the gross NPA of the bank is quite low, and the net NPA is also quite low. So therefore, we feel comfortable, let me say, on the credit quality front. And the good news is that the bank has been holding out on good credit quality, except microfinance. It has been like this for a very long time, so nothing has fundamentally changed. With the microfinance issue behind, like I said before, the fact that the core balance sheet will grow, that will start giving income. So our income line will start growing now. And that will address many issues. It will address the cost income ratio also improve because of that. So there are many benefits from the growth of the balance sheet. Good thing is that even the deposits for the bank is coming very strong.
Okay, that's the word coming in from the management of IDFC First Bank. That stock too soaring in trade today, more than 6% higher. But let's talk about the stock that everybody has been eyeing since morning, and that's RBL Bank, because Dubai-based Emirates NBD is going to acquire 60% stake in the bank through a $3 billion primary infusion, marking the largest foreign direct investment in India's financial sector to date. Now, the deal, approved by both banks' boards, will see RBL issue around 959 million new shares to Emirates NBD via a preferential allotment. And my colleague Ankur Mishra caught up with the management to discuss what this deal means. It's a mega deal. Let's go across and listen in.
This 3 billion is a fresh infusion into the bank. The existing shareholders will continue to be the shareholders of the bank, and it is an additional increasing it from the current level of 60 crores by adding another 90 plus, and it will go to 150 shares. But base increases. And second important thing is that the entire amount is coming inside the bank. That means it is going to provide a long runway for the growth. Normally what will happen is that you will have a part of the amount. We have an option of having it in small tranche or in a big way. These things, in my view, the first thing is that we have to get a shareholders' nod and approval, which I'm sure that the shareholders will take a positive view and do it, because it's going to create a huge value for them. The growth is going to be accelerated with the new products and new services and extra distribution or additional distribution. The bank, which is operating in, let us say, around 561 locations today, may increase it multifold. That's a big opportunity. When this is going to happen, not much of change in employees. Employees will get into that new realm of doing the things. No changes have been contemplated in the management. Also, the management is something which will continue to work with us, because this is the management which has built this structure from what it was 3 years before.
Okay, so not just this one. The moves, which in some of the mid and the smaller banks today has been phenomenal, Kunal. 9% up on AU Small Finance Bank. I don't recall the last time banks had made this kind of a move, and it's secular. Correct. You search for any bank and put its stock price. Yeah. Stock is up. What's the sense? Can this is this move healthy, or is this just a blanket move on everyone, which could turn out to be something where you're cautious about?
No, I think so. There are two parts to it, Harsh. One I remember. I think there was a point for Federal Bank many years back where the stock was stuck at 130 or 140. Correct. I think the stock used to just grind at those levels for years on a trot, and then came a breakout where the stock moved towards 180 and 200. Now the stock was stuck at 200 levels for the last, I think, couple of years or so. So this could be a breakout yet again for Federal Bank of that huge multi-year grind, for the stock, where I would believe that we could be looking at a start of a major uptrend for the stock price. The only surprise which I actually get is IDFC First Bank, because frankly, on the charts, it was looking that the stock was just going through a bit of a sluggish price action. It was going towards that 73, 74 mark, then receding back towards 70. There was 3 or 4 attempts for the stock within this band of 70 to 74. So it just sense that maybe the stock would continue to grind into a trading range. But IDFC First Bank could be a potential strong short-term trading breakout. Now the stock is a little bit more erratic on the charts because it tends to give you that breakout and then slip for the next couple of days before it tends to move up higher. So you'll have to be a bit tricky in terms of catching the stock to try and trade. Maybe buy this on minor dips if it happens for IDFC First Bank in the next couple of days.
Okay, and what about something like an AU Small? What about something like a South Indian Bank, a DCB Bank? Your view on these three in particular, because the moves are so sharp, 10, 11, 14% up. What's the sense like? Do you track it at all? Are there some levels that you're looking at on these?
In fact, start of 2025, AU Small Finance Bank was almost at 450.
Yes.
I think 480 or 500 thereabouts.
Yes.
It was a multi-year low for the stock. And now from that multi-year low to come back to multi-year high, that's a very rare phenomena for stock prices. And that tells you that you're looking at a complete sea change of view. Now, for traders who probably would have exited the stock at 480 levels, if they are looking at re-entry for the stock at 800, this may not be a whipsaw rally again. So you're looking at the possibility of a new trend coming out for even this banking on the mid-cap side of the private sector banking names. And then you try and add all the picture, Harsh, that IDFC First Bank, Federal Bank, you've seen AU Small Finance Bank, Axis, Kotak, all of these stocks are showing signs that we are looking at a point or at the cusp where the banking stocks are about to go into a major breakout going forward. And I think I would also believe in that sense, you can't leave ICICI Bank and HDFC Bank far too long. Yes, today's reaction could be a little bit muted on the result side for both of these names, but I believe it's a matter of time that these stocks will eventually play a catch-up. You just have to be a lot more patient.
Okay, so what we will do is we will be a little more patient, and we will also slip into a very short break, viewers. On the other side, we'll start to take fundamental.
Getting a lot of technical analysis from Kunal on the way Reliance has been performing today, large private sector banks, and in fact, even the mid private sector banks have been doing very well, as has been the case with PSU banks. So let's try and get a fundamental view to where all of these sectors are headed in the medium to the long term. We have Mr. Deepak Shenoy, CEO at Capital Mind Mutual Fund, joining us on the show. Deepak, hi, good afternoon. Thanks for your time and wishing you and your team a very happy Diwali. Thanks for joining us today. And Deepak, the kind of move that we've seen, first of all, on large caps, something like a Reliance, HDFC Bank has been good, banking names have been good with their earnings, and IT also has not been all that bad. Do you believe the next phase of the market could be led ahead by the larger names, the large caps? Is that where the market should be focusing?
Hi, good afternoon. And of course, wish you, your team and all your viewers a very, very happy Diwali.
Thank you.
So I'll quickly dwell on the sectors. The results that have come in so far are encouraging to a certain extent, especially in the financials. I think it's a little early to call because we still have a lot of results remaining, but it looks like the September quarter has been quite okay in terms of both sales growth and a lot more in terms of profit growth. We're seeing more than 15% median earnings growth in all the companies that have reported this far, and that's quite a good start actually. So hopefully the bad results are not towards the end of the quarter. But in general, I'm feeling a little more encouraged about this because we thought the GST impact will actually start to flow in only in the October quarter. So the better results should start flowing in at least from the consumption names only in the October to December quarter. Overall, large caps will benefit if the foreign investor selling pressure starts to reduce, or at least there is some alternative, maybe buying pressure as well, because much of the FI concentration is in the larger caps. So their selling perhaps keeps the Nifty and the larger caps subdued in comparison with the mid and small caps. So I would say that perhaps that is one flow level. But earnings wise, I'm seeing in fact better results from mid and small caps. So we're looking at economic growth. I think we should be focusing on mid and small caps. But currently, smaller flows, we're seeing some incremental relief coming in for the large caps. So hopefully the Nifty will do well in the next year. I'm biased because we are naturally long in our assumptions and in our positions.
Deepak, hi. This is Harsha. It's been a while since we spoke. Deepak, give us a sense. Where's the portfolio tilt towards? It'll likely be towards pockets where there is decent value along with a good growth tailwind on the profitability. So give us a sense on where those pockets are, because H2 likely is going to be a stronger year where growth in profitability is concerned.
Yeah, I think, early names that we're starting to see in portfolios, we have a quantitatively run portfolio. So a lot of it depends on the data that comes in. And the data is coming in slowly as companies announce results. But we're seeing some attention paid towards the healthcare names. I think part of it was news driven also because when the government increased the rates for CGHS, there was a push. But in general, I think healthcare in India is under penetrated and in a way undervalued also for the longer term. Of course, in some names valuations are still rich, but I feel that overall there's a lot of growth coming here. There is possibly some growth that will come towards consumer durables. We're seeing that in auto. The auto names are doing very well, both in terms of reported numbers and in terms of potential for growth because of the GST changes. Some financials, larger banks, larger NBFCs seem to be doing reasonably well. Some of the gold names are also doing reasonably well. So I think that is, those are part of our portfolios. I'm just giving you the mix overall. We're seeing very little FMCG here right now, but early names have started to pop up. And then we want to wait for results to come in before we make an estimation. There is lagging, there's not much as much interest in IT perhaps right now, or in some of the textile names because they have been hit by the export issues with tariffs to the US. But by and large, a lot of the other sectors, the industrials definitely are strongly represented and we're likely to see some incrementally big profit numbers, in the next 6 months, maybe the full financial year, because I think order flows will be have been quite good for them, and then they will start to show these. They will start to show this in the results in this year and the next year.
Okay, so Deepak, those are some sectors that you're liking, but in the previous answer, you made a very interesting point that the large caps can only move if FII buying comes back. Deepak, what in your view will take for FII buying to come back, because we've been largely underperforming and some revival is being seen in the markets now. It's early to say, but the earnings have also looked like they're starting to improve, at least compared to the previous quarter. What is the one trigger that the FIIs could perhaps be waiting for to make them start looking at India in a more attractive manner again?
So I think by and large, it's a cyclical thing for FIs. They kind of exit when they find either valuations or geopolitical issues a problem. Those things have been a problem for the last year or so, both of them in different ways. I think once those issues die down, we will see some change in sentiment of some of the FIs. We're less and less FI dependent going forward. So I think the overall market does not have major impact of FIs either selling or otherwise. But some of the larger caps, especially in the financials, you see the names have been overrepresented in FI books. So you see that they tend to lag when there's a lot of FI selling. I don't think we need FI buying to come back. We just need FI selling to slow down. And perhaps some of that will be because of exhaustion, because they've sold quite a bit already. And then maybe they will be like, okay, we want to, slow it down or keep our allocations to where it is. And that's all that's required really, because domestic investors are now more than 2 times the amount of FI outflows and growing at a reasonable rate. And that will perhaps cause some kind of a fillip onto some of the larger caps, which have become reasonably valued. Earnings, I think we're going to take 2 more quarters to reflect that completely in numbers, and we're going to see some of that reduce their price to earnings ratios to a more reasonable level, at least at current, Nifty levels at least. So we're going to, have to see some of that economic growth kind of percolate down into net profit numbers for the full year before we see a major change in FII sentiment. Perhaps that will only come next year, and it'll probably coincide with either a trade deal or some reduction of geopolitical hostilities, whatever it is supposed to be happening with America and China, that should reach some kind of a conclusion as well. I think that these are the impactful points where I think FIs will reallocate to India. But like I said, there is interest. We've seen big deals coming from even an Emirates bank buying into an Indian bank. We're saying, or I think RBL, that deal was going on. That's a fairly large number for a single bank deal, and there is perhaps that interest will also starting to emerge on the M&A front. That might also change in terms of sentiment going forward.
Hold that thought, Deepak, because that's exactly what we want to speak to you about. Pick your mind. But what we'll have to do is we'll slip into a very short commercial break. On the other side, we'll continue our chat with Deepak Shenoy. Stay with us. With Deepak Shenoy, CEO at Capital Mind Mutual Fund, talking to us about what could lead the rally over the next 12 months. Deepak, the one big mover in trade today, in particular, on the back of all of the numbers that came over the weekend, was outside of a Reliance, some of the banks which have done extremely well. RBL in particular, we did speak about, but some of the smaller banks, they've all surprised where margins are concerned. They've all given positive commentary where credit costs are concerned. And all of these have the ability, or they've demonstrated the ability in the past, to grow at 20% plus for 2, 3, 4 years. Could we see that happening as mid-cap banking? Can it grow at 20% or maybe 15 to 20% also over the next 3 years sustainably without having concerns on asset quality? Do you believe it can do that? Because if that is the case, you could well see a significant re-rating in some of these prices.
Yeah, I think there is no problem for some of the smaller banks to grow, because I think they will eat into larger bank market shares as they adopt more digital. In fact, a lot of the smaller banks are far more digitally aware than some of the larger ones. And as it increasingly becomes obvious that banking is more commoditized, so there's no advantage to being with a large bank than it is to be with a small bank, I think some of these smaller banks will just get an upper hand in terms of their digital capabilities with comparatively slower private and public sector banks. There are lots of public sector banks that aren't exactly as easily engaged as in the digital formats as perhaps their smaller private sector mid-cap banks themselves. And there is a focus towards both secured and now unsecured loan growth as well, as long as parameters are well defined. This may put a dent into asset quality at a later point, but that's a natural thing. You do get if banks are well capitalized, they can handle asset quality equations well if they grow in a proper way. So 20% is not too big. Even a bank like HDFC Bank grew at 30% a year for nearly 10 years. But in a low inflation environment, it is more difficult to grow at the 20-25% because your natural growth is, with interest rates being less. When interest rates are 9 or 10% on a repo, you're lending at 14 or 15%. So you get natural, refinancing growth of 15%. You have to grow an additional maybe 5 or 10% more maximum. And then, you're growing at 25 to 30%. Now, if you have to grow at 20% and your natural loan growth is only about 8 or 9%, you have to bring in 10 to 11% growth, and that will largely come on the back of a lower base. That's what the smaller banks have. And they can venture into territories which were difficult to go into earlier, where, for instance, in Forex or in some of the elements around bonds and, not just from the treasury, but also for customers. They can do a whole lot of other things. A lot of banks focus on certain sectors, and as they grow to a certain size, then they can go into others. Some are only secured loan focused, some do not have that much interest in gold loans initially, some have only unsecured loan exposure. So they have to expand into others. Whichever areas they're concentrated on earlier have to go into the other sector. So they have the ability to grow. Now we'll have to see about delivery, because some banks choose the wrong path and then get into really bad asset quality equations and don't have the capital to back themselves up. Now we're seeing very, very good, CRARs across the board. So a lot of them are very, very strong capital wise. And there is an attraction of foreign capital that wants to recapitalize banks by taking up equity ownership as well. So that will also help them raise more capital as they grow and strengthen their balance sheet. So I think some of the private sector banks, mid-cap banks especially, can surprise us. And I think they will win market share from the smaller NBFCs and from the weaker banks in terms of digital exposure going forward. And I think we'll see a lot more interest in for SME and secured loans in the next year.
It's interesting the point that you make about market share. The smaller guys eating away at the market share of the bigger ones. And I can't help but ask you if that's a trend you see on the retail front as well. You have a lot of these value fashion brands now. They're coming into the listed territory. Same is the case with quick commerce. Where do you think the older marquee players like a D-Mart or a Trent or any big box retail could stand, given that we have so many new players coming into the field now?
I think the game has many types of players. So, for instance, if you get retail brands in, the DMarts may still be a distribution point for them. So they might still, benefit alongside some new brands that are coming in. But if the new format stores or dark stores or whatever have you, I think the larger players need to invest in their infrastructure to be able to take advantage of the new logistics plays that seem to be coming along. Especially when these funded, unlisted players have some pressure to show profits. The minute a sector starts to show some profitability, you can bet that people who are in the listed space, who don't really want to go after deeply unprofitable businesses initially, will be able to put some of their infrastructure to work, whether it's a Reliance or a D-Mart or some of the other formats of retail, which have largely shied away because they don't want to lose too much money. But when the unit economics start to work out, you can see that the players may actually grow sales, but their margins will likely come down, mostly because the profits are spread across more players, and all of them have the digital capabilities to kind of come in and take advantage of the increased logistics footprint that some of the small players have built up for them. So there will be a point at which this industry will grow, but no individual player may take a lion's share. So giving an extremely high valuation to these players is dangerous, because profit margins and growth may not be great at a per player level. It may be great at an industry level, just that there are more players coming. I'd say the same thing even of FMCG when the brands get diluted, and it's so much more easy to now create a new brand and get into customer eyes, because your distribution points are the internet and a lot of these new age products that can bring products to people's houses. And at the same time, the internet is also giving you visibility, whether it is Instagram or Twitter or whatever you have in terms of getting more visibility of a new format product. So I think the problem here is the sector will grow, but maybe the individual players, they shouldn't be too overvalued, because it's difficult to make money in a very highly competitive, even though if it's growing market.
And Deepak, last question. IT, would that at all find favor at this point?
specialized IT, I think, still will have. There's some players
Right.
who are focused on electric vehicles and so on. I think there is something there because you have the ability to kind of in-source a lot of work into India without having to worry about all these H1B issues and so on. But by and large, I'd say until there is a lack or reduction of animosity in the US laws, especially for US focused players, we don't expect growth to be that much, and we expect a lot of influx of sudden big bad news. So some customers slowing down their contracts, some customers rerouting their contracts, and so on, simply because the current environment in the US is not to make a large amount of greater investment in growth beyond this AI phenomenon that's currently over there. But eventually, I think a lot of this, once the dust settles, a lot of work will come back into India. It will come back outsourced to make more work happen in India because moving people across is going to be more difficult. And eventually, there will be profit margins that are even larger than what they are currently. Simply because more work is outsourced, you have these companies have to make their investments in building a lot of the knowledge bases in-house, even in the AI world. And I think they might make larger money because they'll need less people to do it. Not great for the job market, but I think good for the IT companies as they are.
Kunal, how do you view IT in terms of charts? Because that 1% move today, just trying to understand whether anything moves significantly with regard to your view on IT.
So it could be a contra bet, but the time frame I think has to be much higher. I don't see these stocks getting into that zone, sweet zone, like how the banking stocks are or the financial stocks are. They could be very good price-wise buy at current levels. Maybe these stocks may consolidate, not fall, from current levels. But for these stocks to provide those stellar returns, I think without that news flow or even surrounding the stock price, it's going to be difficult. You might have few of the IT names, like for example, Persistent. We were discussing this, I think, last couple of weeks. That stock would probably be one of the outliers in the entire IT or the mid-cap IT space. You might have one of the other names like Coforge, which can do pretty well for itself. But then most of the IT stocks, they would probably be at a price-wise a very good buy, but momentum-wise or in terms of short-term trading-wise, I would still be more of a wait and watch.
Sneh, HUL numbers expected 23rd October.
Oh, yes.
What's in store for consumption? Before we take it across and ask Deepak for a view on consumption.
Well, we're going to be off for 2 days, but earnings are now going to stop because the day we come back, you have HUL from the Nifty group of stocks coming out with its numbers. Muted set of earnings is what we're expecting this time around.
Sure.
Much unlike Nestle, because remember for Nestle, we were expecting a decent set of numbers, and HUL, for the first time ever this quarter, they came out with their quarterly update, wherein they flagged the caution from the GST rationalization and the impact that it has had on their inventory, on their sales. They've mentioned it's a one-off, but yes, they have flagged off some slowdown. And in light of that, consolidated revenue, we're seeing around 16,000 odd crore rupees, which is up at best 0.5% or 1% on a year-on-year basis. Not much to see there. EBITDA has also seen a 3,592 crores, which is a solid 5.5% knock from where it was last year. Net profit also, we're expecting to see it either flat or down perhaps 1% at around 2570. Margins are expected to be in pressure at 22.4% compared to 23.8%. But then again, remember 2 quarters ago the management had guided for 22 to 23%, that range for margins, and this sits well over there, so not much to worry about. But yes, on a year-on-year basis, it is a cut. Underlying volume growth is seen between 2 and 3%, absolutely flat compared to last time as well. So we'll see what happens over here. Low single-digit underlying pricing growth is seen of about 1%. Again, nothing exciting over here. But remember, HUL had taken price cuts in tea and home care, and they had taken a price hike in the skincare segment. So how these segments, be it home care, beauty, personal care or food, how they perform is anybody's guess. Beauty and well-being is expected to be hampered by personal care. It's expected to go down by 4%. Home care and food are expected to do decently okay. So when the numbers do come out, this segmental performance is going to be important to monitor. Their commentary on GST, for how long they think this overhang might persist on their channel, is going to be important to watch out for. Margin guidance revision, if at all they do something, is going to be important. raw material inflation as well as demand from urban versus rural areas. That is going to be very important to watch out for. So yes, numbers from HUL on Thursday, the only Nifty company to come out with its numbers once we come back from this 2-day break. And yes, muted set of numbers expected, just in line with what they had indicated in their quarter 2 update. So that's the take on HUL. I believe Deepak is still with us. Deepak, your take on some of these consumer staples. Nestle has been a very positive surprise, but then again, HUL we're expecting to see some muted numbers. How should one infer the growth from the consumer staple segment this time around, because the GST overhang could be here for a couple of quarters?
To be fair, I don't particularly like them on a fundamental basis because if you think about their growth in the last maybe even 10 years, they're talking about 10 to 15% growth. They're valued at 40 to 50 times earnings. I mean, I understand high ROEs and all that, but honestly, growing at 15%, you can't justify these 50, 60 times multiples. And I believe in the long term, it is not going to be such a great thing. It may be useful as short-term plays at different points, but not very exciting. There will be other plays in the consumer. Like I said, the brands are also they're getting competition from different types of brands, and all of those will eat into their market share at some point and mind share as well. So I would say not very bullish on these stocks long term. I haven't been for the last 3 or 4 years, and you haven't seen meaningful growth from them on a stock price basis. Their P's have come down from the 80, 90, 100 times to maybe even the 50, 60 times. I still think they're extremely overvalued. So while they may grow a little bit, the GST thing won't impact them too much because by and large, they try to keep the prices the same, even if their input costs change by increasing grammage, if their input costs fell down. So a lot of the FMCG names are not going to report great numbers, even in the quarter going forward, because of an increase in consumption. I think the durables will do better rather than the staples. So not very keen on this right now.
Right, Deepak, then how do you play consumption? Very quickly.
Durables, I think that's the way the thing is. People will buy more fridges, TVs, cars, things which have a really visible impact of a downward GST play and are also long-term consumption goods, not something that's just fast-moving. Competition here is relatively lesser also, but it's also that we're growing this sector in a tremendous place, both from domestic manufacturing, the ability to introduce more brands. You've seen at least 2 more brands list in the auto space itself. And I think more of them will come. So I'd say that's the play-to-play consumption.
Deepak, your one key sector, segment, pocket, stock for which will likely give very good returns from this somewhat to the next for our viewers?
I feel domestic manufacturing. That's still underplayed in a large way. Precision.
But that's too large. That's too broad, Deepak. Anything narrower?
No, I won't go into stock level.
Sure.
But I think this is the broader theory. Yeah.
Okay, great. Thank you so much, Deepak, for joining us this afternoon. We'll let you go on that note. And while we're talking somewhat to somewhat, viewers, let's also take a quick look back at how the last year has fared for the Indian markets. Rabinder joins us with a somewhat to somewhat market recap. Rabinder.
Well, as Indian market has delivered a mixed set of return from last summer to till date. If we talk about Nifty 50 index, the Nifty 50 index has given a gain of 7%, and Nifty mid cap has given a returns of 5.9%. But while Nifty small cap has underperformed both Nifty mid cap and Nifty 50 stock. And if we talk about Nifty 50 top gainers and losers from last summer to till date, then the Bajaj Finance was the top gainers of the Nifty 50 index with a return of 57%, which is followed by Maruti Suzuki, Interglobe Aviation, BEL, Eicher Motors. And on the flip side, if we talk about the losers of the Nifty 50 index for this summer, then Trent was the top losers of the Nifty 50 index with a 32% decline, and which is followed by TCS, Tata Motors, and Infosys, and which is followed by NTPC. And if we talk about the Nifty mid cap index top gainers and losers from last summer to till date, then from the mid cap space, L&T Finance has given a stellar return of more than 83%, which is followed by Fortis Health, Muthoot Finance, BSC Limited. And on the flip side, the top losers of the Nifty mid-caps index was Sona BLW, where Sona BLW has declined more than 33% from last summer to till date, which is followed by Tata Technologies Tube Investment of India RVNL Torrent Power, with Torrent Power decline 28%. Now coming to small cap index, then the small cap index top gainers was Laurus Lab, which has given a more than 87% return from the last summer to till date, which is followed by Manappuram Finance, HBL Engineering, GRSC, Aster DM. And if we talk about the losers of the Nifty small cap from the last summer to till date, then the Tejas Network was the top losers of the Nifty small cap, where Tejas Network has declined more than 60% from last summer to till date, which is followed by Brainbees Solution, Jindal Saw, Natco Pharma, and AB Real Estate, with AB Real Estate declined 40%. And if we talk about the sectoral indices, then Nifty PSU Bank was the top sectoral gainers from the last summer to till date, with the Nifty PSU Bank has given a return of 17%, which is followed by Nifty Auto with 16%. And on the flip side, Nifty IT was a top sectoral losers in this summer, with the Nifty IT declined 13%. And if we talk about the gainers of the Nifty PSU Bank, then from the Nifty PSU space, then Indian Bank, Canara Bank, PNB, Union Bank of India, and Bank of India was the top gainers of the Nifty PSU Bank. On the flip side, Nifty IT, if we talk about Nifty IT top losers, then TCS, Oracle Financial Services, Infosys, HCL Tech, Wipro with TCS declined more than 25% to from last summer to till date. And if we talk about the FIDI data, then from last summer to till date, the FI has sold more than 3.15 lakh crore in the Indian market, and but on the flip side, DIA had bought more than 6.85 lakh crore from the last summer to till date. And lastly, if we talk about how the Indian market has, if we compare the Indian markets with the other world indices from the last summer to till date, where Korea's Kospi index has given a 49% from the last summer to till date, which is followed by DAX, Nikkei, and Hang Seng. And Nifty has given a 7% return from the last summer to till date, and Nifty has underperformed other world indices.
Okay, thank you for that, Rabinder. Breaking that down for us, just so many elements, and you've broken it down very, very well. Kunal, on the index, what's your call? This somewhat to next somewhat. Give us a range. What could the upsides be and what could the downsides be?
See, I'll not give a range. In fact, I'll look to aim for a target for the
Even
index. So assuming if in the next couple of months, I think the next couple of months are the most crucial ones for the index. Assuming if there's nothing negative which comes out from the globe, then I think by March 2026, I think I would probably look at the Nifty hitting 27,500 to 28,000.
Wow, that is amazing. And what about 3 picks, this somewhat to the next?
That's the more tougher one. So I'll go with the ones which are the more newfound momentum stocks. Paytm, I think, is one of them. The stock heading towards a major breakout. It's a turnaround of sorts for Paytm, at least on the charts. I think at 1250, 1300 where the stock is right now, I would look at, say, a 30% upside for the stock in the next 1 year. So which means potentially somewhere around 1600 as a near-term target for in the medium-term target for Paytm. I will also look at Vodafone Idea, a stock which I've been bullish on of late, and I think from that 7.5 levels, which is a breakout point for Vodafone Idea, I would probably expect the stock to head towards at least 12.5 to 15 kind of a range over the next 1 year. And the third pick, if I have to bet, I'll go with the safer, larger cap name, and that would be HDFC Bank. And as I said, you can't leave out HDFC Bank far behind if you're expecting the Bank Nifty to perform very well over the next 6 to 12 months. And potentially my targets over there would be in the range of 1150 to 1200.
I don't hear any of the NBFCs in that list. And NBFC, both within the Nifty mid-cap as well as the Nifty 50, have been the top gainers. Bajaj Finance in the Nifty 50 and L&T Finance in the Nifty
You
mid-cap.
asked only for 3.
Let's expand that to 5 then. I need an NBFC there, Kunal.
So I'll not take the usual, the larger cap NBFC names, but if I have to look at the mid cap end, I would probably go with L&T Finance and AB Capital. These are the 2 stocks which I've been very bullish on, and I would continue to be bullish on these stocks even from here.
Okay, across to Snehi, she's waiting by on the market wrap.
Well, yes, sir. Let's take a look at the kind of day we've had today. Excellent day, no complaints. And the way we're heading into the Diwali holiday, absolutely no complaints over there. A 0.5% uptick on the Nifty. Yes, we've simmered down slightly from the day's high, but not too much because the recovery also once again has been good enough. 25,850 thereabouts is where we are at. Let's hope to close above that 850 mark on the Nifty. Sensex too, a good 0.3% up, 0.5% uptick coming in, pardon me. So that is also looking good today. If you take a look at the broader end of the market, two very good moves coming in the small cap also in tandem with the benchmarks, but the mid cap index has outperformed yet again today. The advance decline ratio very steeply in the favor of the advances today, so that also looks good. And overall the breadth of the market has been very healthy. It's names like Cipla up 4%, the top Nifty gainer that overtook Reliance, which was the top Nifty gainer for the majority of the day, up about 3.5%. Bajaj Finserv, Shriram Finance, Dr. Reddy's Labs, that was the list of the top Nifty gainers today. Overall today the flavor of the market has been banks and financials, be it PSU banks, be it large cap banks, mid cap banks, anything from a Bank of Baroda, Central Bank, Maharashtra Bank, PSB, PNB to an HDFC Bank. All of them have done phenomenally well, as has been the case with IDFC First, Federal, a lot of these mid-tier banks. RBL Bank, of course, the flavor of the day today. All eyes were on that stock as well on the back of that Emirates NBD acquisition news coming in. But other than that also, other stocks like rubber stocks, your tire stocks, CEAT, JK Tire, Apollo Tires, all of them did very well. So well, with that we'll wrap it up on this edition of Closing Trades. But yes, this somewhat looks to be ending quite well. 25,850 is where we are at on the Nifty. It's a 0.5% uptick, and with that we'll wrap it up on Closing Trades. Thanks so much for watching and wishing all our viewers and their families a very happy Diwali.